Hello and welcome to this Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. And if you just found this video on a YouTube channel, you should know that this is part of a bigger blog piece that you can find at MarketGauge.com, avoid-bear-markets. So in this video, I'm going to show you how you can use January's monthly range to help you avoid major bear markets. Now, as I cover in the blog post, but I'll go over quickly here, the premise of this is that if you understand how to simply trade a line, all right, so if you take any line or you put a line on a chart, if it's a significant inflection point in the market, there are some pretty basic trading tactics that you can use to trade from the bearish side when the price is under that line and from the bullish side when you're over that line. Now, depending on which line you're using, you may want to put more of an emphasis on the bearish or more of an emphasis on the bullish. But we won't necessarily have to go into that in this presentation because, as you're about to see, if you use the low of the month of January as your line, you can effectively avoid major market declines. So what we're looking at here on this chart is a monthly chart of the S&P 500 going all the way back to 1961, right? Because I'm using this video to give you some more history that would have just taken way too long to type out in the blog post. So the red dotted lines that you see on this chart are the low of January carried out through the rest of the year. Now, the green dotted lines I've put as smaller because we're not going to focus on that, but it is the high of the range for January. So before I get started with this, some of you may be thinking, this sounds a lot like that opening range stuff that Market Gauge teaches, and it absolutely is. So if you're familiar with our 30-minute opening range instruction, we're applying a lot of the same tactics to this line. It just happens to be on a monthly chart, and we look at it on the daily chart at the end of the month as well. So let's just dive into it. I want to keep this really straightforward so that you can see the concept. You can always make it more complicated or more sophisticated, but if you just get the basic concept, you can be way ahead. All right, so as I said, what we're trying to do here is simply avoid major bear markets. So we're going to look at periods when the markets run up. So here's 1961, the market runs up, and then here's the January low. So if you're trading below that line, you want to be bearish or at least defensive. But if you take that posture, you shouldn't find yourself surprised or hurt by a major decline like this. So after that, the market rallies. Now, you might look at this and say, well, you might have gotten head faked there. But again, this gets back to if you can trade a line, be cautious under the line. And in fact, as I'll say later in the video, if you get more sophisticated about it, you can actually trade the reversals at that line. But more importantly, that might have been a warning, all right, but it turns right around and goes back up. Here's your warning again, and when it continues lower, you want to be out of the way. This is a major decline here. This is going from over 90 to almost 75, so that's a significant market decline. Moves up, moves up, moves up. The other thing I want to point out here is that so far, and I admittedly, we're only in the 1960s so far, but what you're going to see is that there aren't a whole lot of really major declines that, I mean, almost none, that would have caught you by surprise. So during bull markets, when everybody gets a little bit crazy about, well, the next bear market's going to come and I don't want to be caught off guard, this is how you can draw your line. For the whole year, you're going to pay attention to that line, and when you get trading underneath it, you got to be defensive and you won't get caught in this mess. Right? Again, another bull market in here from 70 up to 73. This one right at the top, effectively, take out the high of that January month, and you could avoid all this pain, right? And then the market rallies back up. See, one of the reasons I went back this far is because, it's as far as my data would go. But you can see this is actually a pretty choppy period in the market. Pull back under the January avoid the sell-off. So let's keep going. Now that you get the hang of it, we can go pretty quickly, right? And you can do this yourself. I'm just pulling up a monthly chart and watching for that level. Here's the level after a pretty significant rally. You miss that. You get a nice significant rally. You pull under it. You miss that. You get a nice significant rally. You pull under it. Now, this isn't a major bear market, right? But again, if you're bearish under the line and then you're bullish over the line, then you don't have to worry about missing big moves like this. And as I said earlier, the green line is the high of that range. And so when you understand how to use the January range from a positive point of view, it will pretty much do the opposite for you to catch the bull moves. So interestingly here's 1987, right? 1987 crashes. It doesn't continue once it breaks down below that line. It stops, comes back into that January range, and from there you have a 2-year bull move back up to the new highs. You have your warning here, but remember, back into the January range, you can be bullish again. All right, now, just because you're over the January low doesn't mean that it's full steam ahead from the bullish point of view. Depending on the skills you have as a trader, you may want to wait for more confirmation than that. But again, the point of this video is to feel comfortable that you've got a good warning mechanism to keep you out of major declines. All right, so after 87, as I said, we rally up, we pull back, a little bit of a head fake here in 1990, but then after that, higher, higher, higher. A little bit of a rollover head fake here in 94, but again, it doesn't have to be a bad head fake if you know when you can turn around and get bullish again. Market has the amazing move of the 1990s into 2000. Notice how the low of January was never even violated from 95 all the way up until 2000, and then when it finally broke the 2000, finally broke a January low in a significant way here. And then again in 01, that was the beginning of the tech route, basically, into the lows of 02, right? And then as we watch 02, you can see same basic story. We had some moves underneath it, and there's where you would be cautious. But if you got a significant move below it, again, cautious here. This is 2007, your first warning. And this is a little misleading, right? Because this break below 1400, you have a big sell-off here. It just comes right back. You don't want to have to sit through that, right? And so 2008, I'm sure you probably remember that route. Again, just being focused on the fact that you're trading below that January low could have kept you out of a lot of trouble. Moving into the depths of 2009, turns around. Had a little bit of a scare here in 2010, no doubt. But if you're conscientious about it, you don't want to be sitting through this kind of volatility on the downside. That's the whole point of this. So for me, I'm happy to be cautious under the monthly low so I don't have to sit through this. And certainly, I won't be surprised if the market takes out a January low if we get a major decline. Right? So after 2010, you can see the January lows hold pretty well. Then we get to 2015. It's kind of a mess, right? I don't know if you remember 2016 as vividly as I do, but this was an ugly summer move, and then the move into January was pretty ugly there, but then off to the races after that. So this area in here, big trend January, you could have actually easily avoided. I'll get to that in just a second. So that brings us to where we are today, and you can see that again this year, staying cautious when you're under that January low has been the right thing to do. So I just mentioned a few minutes ago, and I'm not going to go into it in this video because my emphasis here was the big picture, right? The big picture is caution under that January low. But we do also look at patterns, 2 other patterns within the month of January, so that in environments or years like 2016 where you have major trend Januaries, or 2018 where we had a major trend January, you can still catch the trend within January. It's just obviously a different tactic since we can't wait until the end of the month. But if you want to learn more about stuff like that, go to the blog post that this is coming out of, www.marketgauge.com/avoid-bear-markets. You'll also find more trading tutorial videos like this at marketgauge.com/tutorials.